Welcome to Track Room 3. We are about to start on our CFO Insider track. This is sponsored by Pollen VC. And our first session, kicking off at 2:50, is a 20-minute session entitled How to Measure and Compare Financial Returns on UA Spend. And this is a session with Martin Macmillan, the CEO and founder of Pollen, who is right here.
Okay, so I'm Martin Macmillan. I'm the founder of Pollen VC. As a company, we provide debt facilities to companies to scale using paid user acquisition. Our sort of wider purpose, if you like, and the reason we do these sorts of sessions is basically to try and improve the financial literacy of gaming studios. Gaming studios don't typically appoint CFOs until much later stage than most other companies. So the whole idea here is to provide some financial education, particularly interfacing between UA managers and finance leads and founders to engineer better financial outcomes. So I'm going to start off here, like the concept, everyone's very focused on ROAS, ROI, but basically it's a meaningless metric unless you give it some context of time. So you might hear a UA manager talk about, hey, my game's got 130% ROAS, fantastic, congratulations, but that's kind of irrelevant unless you give it the context. Are you making 130% in a week, a month, a year? Right, so it's unless there's some contextualization around time, then the whole thing is a little bit meaningless. So in terms of like the typical journey of a cohort, so UA is just an investment equation. How much in? When do I break even? How much out? So what we're doing here is we from a cash P&L point of view, we're investing. We break even, let's say day 270, and then after 2 years, right? This is a much longer LTV game. Then we get we make our profit. So for the first 270 days, all you're doing is basically paying Google or Facebook or TikTok for the ad. Your rewards only come after you've broken even. So then you think about the whole genre, the whole spectrum of LTV cycles. This comes down to what sort of games you actually want to build. So if you think about, let's just start off, one end of the spectrum, you've got hyper casual, super quick, snackable games, LTVs done in basically 30 days. So this example, let's say you make a 20% return on a 1 month basis. And then right at the other end, you've got a social casino where you might break even like after a year, maybe 400 days, and people will keep playing this game for years and years and years, and you're measuring LTV in like a 1,000-day return. And this maybe has a much bigger number. So and that might be 180%, it might be 250%, whatever it might be. So there's this whole spectrum of games, mid-core in between, like let's say you're breaking even in 3 months, you think of LTV in a 1 year. Merge even longer. So think of it as a whole spectrum. Now, in order to make informed decisions across different types of genres, maybe you're a UA manager with multiple games, you're trying to figure out where am I going to make the best return, you've got to give it the context of time. And so the way we look at it from a financing perspective is the concept of monthly ROI. So breaking down this whole journey into something that I can compare against different genres, different games, etc. So you get a monthly return on investment, monthly ROAS return, whatever you want to call it. So let's go back to the existing example of hyper casual, where we're looking at a game that's going to break even in day 5, and then it's going to go on to make, you invest 20 cents, you get your 20 cents back day 5, and then after 30 days, basically everyone stopped playing the game and you've made a total of 4 cents of profit after you paid the UA. That's actually giving you a 20% monthly return, but that's across one single shot of the game. So we're going to go a little bit longer. Oh, sorry, I need to go back for a second. So giving you, in terms of a monthly return, it's only measured across a month, so I'm making a 20% return in that month. Let's go a little bit longer. A mid-core game, $3 invested, breaks even day 90, goes on to make a 1-year LTV of $4.20. So you're making a net profit of $1.20, which is a 40% over that over the course of the year. Now, when you break it down, if you just divide it by 12, which we're going to talk about in a second, but to get on a monthly return on capital, So 3.3%. So I can invest $1, and that dollar's worth $1.103 at the end of the month, right? So much, much lower return over a longer period. And then you've got a really long game. So say I invest $5 into my merge game, breaking even, maybe a bit generously, day 270, and I go on to make a 2-year LTV of $8. So I'm making a total of 60% return on my UA, but it's taking me 2 years to do that. So by the time I divide it down into a monthly metric for comparison, I'm only making 2.5% per month. Now, that may be a great return for that genre, but just again, you start to see the differences in how the different genres can be monetized. So back to this one with an extra column, you've got hyper casual, you've got like super, you've got very good returns, but it's only one shot. Longer, the longer you get, typically, unless you've got some stellar returns out of like super long LTV games, the monthly returns typically go down. I didn't even bother for social casino there. Now, without getting like overly technical, convexity of the curve, the shape of your LTV curve is very important. So what we did there, just dividing it by 12 or 24, is just a simple linear, it assumes a linear calculation, which obviously doesn't happen. LTV curves can be more convex or less convex, but they're generally never linear. So the convexity of the LTV curve basically is giving you, if you think about it, you're earning more money quicker, and then the rate that you're earning slows down over time. So this actually plays to your advantage. The more convex the LTV curve, the quicker you're earning the money, then the quicker you can redeploy it. So I wasn't going to try and assume convexity. It's kind of a bit beyond the scope of here, but what I'm saying is when you're building your own models, don't forget about it, because it matters. So one of the things we do as a company, we have a whole suite of ROAS, LTV, and cash flow modeling tools on our website at pollen.vc. There's a tab called calculators. And in that, there's a series of tools that for free-to-play games or apps, we allow you to model retention, ARPDAU, acquisition costs, and we'll graphically build how the LTV curve looks when you break even, all of these. And then at the top, there's another tab around cash flows where you model the scenarios around how much cash you have, how that capital is deployed. So how to calculate it? It's actually just a very simple, straight formula. Think about, first of all, your profit, your CAC minus your LTV. That's the amount of money that you're making. And then think of that as basically you divide the profit over what you paid for the user over the calculation. And then you look at the, to get the lifetime ROI, and then you take the lifetime ROI and divide it by the number of days it's taken to achieve and multiply it by 30. So if I've got 103-day LTV, I divide the number by 103, multiply it by 30 to get the monthly ROI. And then you can take that and you can compare that against different genres, different games, different UA, maybe geo opportunities, how long it's going to take to recover. So it all sounds very simple, but back in the real world, in terms of thinking what sorts of games you want to actually make, genre is really important. So let's go back to your hyper-casual the issue is like these cannonballs that yield a 20% monthly return are few and far between. Now, maybe you're a hyper-casual publisher with amazing deal flow, and you can just keep knocking them out one after another and keep making that 20% return month on month. Realistically, it's very hard to do so. So for hyper-casual studios, unless you can be assured of just like firing out hit after hit, those very large, very quick returns are very hard to achieve. Go to the other side where you've got your puzzle merge games, much longer scenarios, right? The issue is there, it takes a lot of money to scale one of those games. If you've got a 270-day or a 300 or 400, before a cohort is projected to break even, that requires a shitload of money to actually get that, to get any meaningful form of scale. And one of the things we're seeing in the market is, whereas maybe last year VCs were happy to equity fund long-dated UA because the perception was like there was so much kind of LTV potential in the game, I think these days are changing now, and there's much less appetite to do that. So basically, when you're thinking about what sort of games you want to make. It unfortunately sort of comes down to the Goldilocks. So some of them are like super short, but it's just very, very hard to get any velocity. Some of them are super long, and increasingly we're seeing people who want to, but they start off in terms of the games that they want to create. They're thinking about, okay, what's a realistic time horizon? So if I can get something to break even in a 90 to 180 day time horizon, that feels like a more palatable game to fund with some debt, some equity to actually and to see those returns. It's not requiring huge amounts of capital to actually scale it up. So when building the models, you think about how much cash do I actually need in order to scale a game? So what you would do is, for the ROAS curve, look at all the different things, your ad network credit lines, etc. And then ultimately you're focused on one thing: how cash negative do I go before I start to actually generate some profit? And then basically the level of that, the trough of that cash flow would be theoretically how much equity you would need to raise. Now, you don't need to raise it all at once. You could raise it in tranches, etc., based on milestones. But that's basically how negative your bank balance would go. That's the external funding requirement. So to go back to how much it would cost, thinking about the traditional way to do that. So let's say our merge game is going to break even to day 270. And you've got a very ambitious, lofty goal of spending $100,000 a day. That's the sort of, that's where you need to be to compete with the big guys. So what you're really saying is that in order to, the amount of money you're going to need to execute your plan of spending $100,000 a day and see if you were right on UA, you need $27 million before your first cohort is projected to break even. And we all know there's a lot of things that can happen along that journey. So this is the thing. This is the issue with these longer games that were they're super popular over the last couple of years. Tons and tons, boatloads of venture money pouring into them because they were seen as, LTV generation, cash generation machines over the long term. But unfortunately, they're very, very hard. They're very, very expensive to fund over the shorter term. So then you think about, okay, I've got this trough. How am I going to fund it? Of course, you can raise it. You can raise venture capital. Do so. Many did. Hundreds or billions of dollars invested into gaming over the last few years. But I think it's fair to say that for most venture funds, whilst a lot of stuff is happening in the early stage, seed and Series A, people are really kind of passing on the big, hey, I need 20 million, 50 million, whatever, to scale this game, because they see it as just going into basically a kind of risky, long-term UA investment. Next one you see. Not so much the factoring side, but revenue-based loans. There's been a glut of people coming into the market saying, hey, we'll lend you money. You put it into user acquisition, and we hope that you're good enough at UA so we can take a skim and get repaid. Personally, I think that's a really bad business, because you are taking just a cold bet on something that you expect to happen in the future. And as the capital markets tighten, I know that some of the revenue-based lenders in the e-commerce space and SaaS space have had huge layoffs, huge default rates, and so on as well. So you need to really think twice whether that's a good fit. Certain banks at a certain level of scale will offer AR facilities and some venture debt. We've written fairly extensively why the bank model is very clunky. The cost of capital may be cheaper, but the way they actually verify, and it doesn't really work for scaling games. The verification periods are very long, the covenants are very restrictive, and typically the banks won't lend you enough when you need it if you're looking to scale up UA. So of course lots of people, hopefully less so these days, go to publishers and say, hey, I've got a great game, but I just don't have the means. So they're prepared to give up a 50 or 60 or 70% revenue share for having someone rent their balance sheet and program ads. I'm sure there's lots of other value they provide, but if you're looking at just through a financial lens, that's really a big part of what the publishers do. So the other thing about going with a publisher is that you're very, very unlikely to ever sell your business if someone else publishes your games. We ran some data last year where we looked at the primary business model of all studios that were sold between, I think, January 21 and then January 20 and June 21. 83% of the studios that were sold were self-published. 15% were publishers of third-party games, and only 2% of the M&A activity was someone who relied on a publisher to take their games to market. Ergo, if you ever want to sell your business, you need to learn to self-publish. And then lastly, there's what we do as a business, non-bank revolving credit. Basically what we do is we look at two things every day. We look at the amount of money that's trapped up in the platforms that has been earned but not paid, and we allow you to access that capital next day, all of that next day. The other thing also that goes into that calculation is we look at the value that's trapped in your existing cohorts. So very specifically, this is not cohorts that we're going to give you money and you're going to acquire. You've already acquired them, and they are at some different way of planning out. So we look at those two numbers, and we've got all sorts of credit models and fancy stuff that tells us or gives us an indication of what's left in the pot. And then this is just an elastic credit line. So when your UA is working, you double down as much as you can, and when it's not, you pull it back. So it's literally a very simple calculation. What's my monthly return on capital, going back to mROI, and what's my cost? So if I have a cost of, say, 1%, or we'll call it 1.5% per month, is my cost of capital, but I'm making 15% return on capital every month, my cost versus return of funding it this way is a no-brainer. The cost of funds versus the return is a rounding error. So look at your, and always compare on the same basis. You look at a monthly cost as an interest rate, and then you look at monthly return as an interest rate, and that's going to tell you whether this is a good way to scale your business or not. So I was on a plane back from Cyprus a couple of weeks ago, and came up with this analogy I just kept thinking through in my head, which is basically around, you're a farmer and you're deciding what sort of crop that you're wanting to take to market. So in this case, we decide to farm salad greens, call it cress. So we plant our cress, we water it, we put it under hydroponics, it's all there. 7 days, we take the crop to market and sell it. So not much that can go wrong in that time frame. Not very sexy maybe, and you've got to keep doing this a lot. So think hyper-casual is like the cress farmer. Then, the big sexy crop, so sugarcane. Average time to harvest is 360 days. So you plant it, you have extensive watering, extensive fertilizer costs, and making sure that you can actually realize that harvest. And there's lots of stuff that you can't predict. Your models, the best models in the world, can't predict if a drought is going to come, or a flood, or disease on the crop, or war. Very, very, the longer you leave it, the more things there are to go wrong. So basically, when you're thinking about it, what kind of games you're creating, think about these time horizons, particularly as the markets change. How much appetite have you got for, farming sugarcane versus cress, and maybe there's a happy medium in between. So, key things from the presentation. Think about this in terms of what crop, what genre are you going to be in, and how much risk appetite have you got. Definitely be realistic. I mean, the number of times we've seen like the old golden cohort, and then projections done off these financial models that are simply just totally unrealistic. Don't fall into the trap of thinking, if you look at industry benchmarks for retention and so on, don't be too far away from there, at least in your initial projections. Now, if you happen to massively outperform, great. Once you have more data, get more kind of ballsy with your metrics. And then think about this mROI, monthly return, ROAS, whatever you want to call it. Just think about monthly returns that allow you to work with your finance teams, right? Because it should be UA and finance coming together. And the best outcome is where everyone understands each other's business. The UA team sit down, the finance team say, hey, we've got this machine that we can make a 6 or 7% return on capital. So my job as the UA manager is to keep the handle cranking, and the job of the finance team is to make sure there's enough meat to put in the sausage machine to keep it cranking. And having that sort of monthly return is something that people can get their heads around. So finance teams can understand it, UA teams can understand it. So we just wanted to put that out there. Hopefully that's useful in factoring in some of your own thoughts. I think it's showing I've got like 1, maybe 2 minutes left. I don't know if anyone's got any very quick questions.
We can just squeeze in a question or two if we want to go with a question. Well, we're all good. We're all good. We're right on track. Thank you for that,
Great.
Martin. That flew by. That was
Thanks,
fantastic. Thanks so much for that.